Hello, this is Dean Tinney. I'm coming to you from my studio in fabulous Las Vegas. We've been talking for a while about explicating the content outlines from FINRA on the various exams. I put those at the front of the playlist on the YouTube channel. Basically, you go to your series and there's a playlist for the lectures. There is lots of great content for the SIE, lots of lectures. But we're just adding this to the mix and I'll put it in the playlist. Now that we're going to be explicating this, so I'm going to go through this pretty quickly. I don't intend on lecturing the whole thing over again. I just want to point out some things to you. This is section 1. We'll go through some high-risk areas, target-rich areas in section 1. I'm going to try and keep this to about 30 minutes. So let's see if we can do section 1 in a meaningful way in 30 minutes. We run over, but that's the game plan. All right, well, section 1 of your exam is 12 questions, and it's about capital markets on the SIE. And you're held accountable to know the regulatory entities, the agencies, and various market participants. And the first thing you need to know about is the SEC, the Securities and Exchange Commission. In 1933 and 34, right, President Roosevelt, all that legislation was called the New Deal. That means the old deal must have been, not so good, not bueno, right? The old deal was, trust me, you'll love it. That was the Roaring 20s. The end of the Roaring 20s, there was a crash. And President Roosevelt said, you guys in the securities industry will thank me, but I'm going to change it. And so what we passed was two major pieces of securities legislation, 1933. Let me get a different color for that. Let's see if we can put it in a different color for you. Let's see, we want red. Give me red. It's not coming up red. Yeah, I got to go all the way back to get red. Let's try it again. Oh, well, 1933, known as the Prospectus Act or Paper Act. And that was passed, the 33 Act was passed in December. And they knew, Congress knew when they came back, they were going to pass 34 in January. So they were companion pieces, but that's known as the Prospectus Act, also known as the Paper Act. And what that basically says is if you're going to sell brand new securities to the public, you need to make a registration statement. And hence the term registered securities. Pay attention to the word public. There's going to be exemptions to this if you're not selling securities to the public. You need to register those securities under 33. And hence the word registered securities. And the other piece of legislation was 1934. And that's known as the People and Places Act, aka People and Places. What you can do sometimes get questions right by just covering up the screen and saying, are they asking about prospectuses, paper, 33? Are they asking about people and places, 34? And 34 created the SEC, gave the SEC, Securities Exchange Commission, primary jurisdiction, interpretation, and enforcement of the domestic securities laws of the United States of America, right? So kind of like God in the securities industry, right? And so, the theory, the best gamekeeper is a former poacher. Joe Kennedy was the first chairman of the SEC, knew all the games. He closed them down. Right now we have a guy, it'll be interesting how he plays out as chairman of the SEC, Gensler. He's a former Goldman Sachs guy. He's not an attorney. I like that model, by the way. Means we're going to be hard pressed to convince him he doesn't understand the securities industry if he's a participant, like we are. Anyway, so the Securities Exchange Commission, definitely testable. They have primary jurisdiction, interpretation, and enforcement of the domestic securities laws of the United States of America. And the two major securities acts are 33, the Prospectus Act, aka also known as the Paper Act. That's for you to help you as a test taker, keep them straight in your own mind. And 34, known as the People and Places Act, and that created the SEC. Now, there are various self-regulatory organizations you're held accountable for on your exam. Tell you what, why don't I get my tool here? And one of those organizations you're held accountable for is FINRA. Let's get a bigger font for that. And, there's four things you're held accountable for. FINRA is the self-regulatory organization for the securities industry. And one thing they have is what's called the Code of arbitration, which is used to settle civil disputes. And you should definitely know that arbitration decisions are final and binding. Another thing that the FINRA has that we're held accountable for is the Code of Procedure. The Code of Procedure handles trade practice complaints. For example, if a market maker is failing to honor a firm quote, that's called backing away. And you would turn me into, if I was that market maker, you'd turn me into the Department of Enforcement of FINRA, and the Department of Enforcement or the Code of Procedure would, contact me, say, Dean, we've had reports that you're doing that. Very important, the Code of Conduct. The Code of Conduct. The Code of Conduct is the ethical behavior that associated persons and broker dealers owe customers. Very important. We agree that we're not going to churn, we're not going to front run, we're not going to sell away, we're not going to sell dividends, we're not going to make breakpoint sales. All the things we agree we are going to do ethically, we are going to do are things we're not going to do unethical things. And then we also have the Uniform Practice Code. And the Uniform Practice Code is very testable. I can't imagine any draw in which you don't get asked about the Uniform Practice Code and some of its components. The Uniform Practice Code standardizes secondary trading in the securities industry. You can imagine what a mess the securities industry would be if everybody's conducting business differently. And so the Uniform Practice Code says, for example, very testable, the regular rate settlement for corporates and munis is going to be T+1. It says that for corporates and munis, the bonds are going to be 30-day months in terms of calculating accrued interest, which means a 360-day year. We probably should say that this is corporates and munis. Looks like I'm running out of space here, so let me move that up. And we're going to find out GOVIES are goofy. GOVIES, and when I say GOVIES, I mean U.S. government securities are T+2. And they use an actual 365 calendar. And that too is very testable to know how things trade. So Uniform Practice Code, which standardizes practices within the securities industry, is very testable. You should know that FINRA is the self-regulatory organization. That's what SRO means, self-regulatory organization for the securities industry. Now, there are a couple of things that you're held accountable for about the MSRB. The MSRB is the Municipal Securities Rulemaking Board. And the MSRB has A rules, administrative rules. They have D rules, definitional rules, and they have G rules, general rules. And the one I'd be aware of on your SIE is G37. That's about campaign contributions. And the MSRB says that you have to be able to vote for somebody if you're going to make a political campaign contribution. And if you can vote for them, the most you can give them is $250 per election cycle. And so I would certainly know that as well. Again, I'll refer you to the various lectures we have available to you. That's not what we're doing here as we work our way through here, this content outline provided by FINRA. Sometimes when I'm teaching, people will say, well, how do you know that's not on the test? And I say, well, they can't arbitrarily just pull things into a test. They publish the content outline. If it's not in the content outline, they're not allowed to test you on it. Now, if it is in the content outline, well, then that's a fair game, certainly. All right, so we're just explicating section 1 of the content outline provided by FINRA for this thing. So we've talked about I wouldn't worry about the Chicago Board of Options Exchange. I wouldn't worry at all about the CBO as an SRO in terms of a test, but the Department of Treasury is concerned with, and let's put that in there. My original intent. Let's see if I can get my red thing. If I can't, I'm going to give up here if I can't get it going, but Department of Treasury. There we go. We have what's called FINCEN. And FINCEN is where we banks file. The Bank Secrecy Act, I would know that, gives, banks the cover, for lack of a better word, to send certain documents to FINCEN, the Department of Treasury, Bank Secrecy Act. And the two we're concerned with is the CTR, and that's for more than $10,000. So if you do a currency transaction for more than $10,000, the person who receives that cash, in this case, the brokerage firm, because you're taking a securities industry essential exam, but it could be a car dealer, motorcycle dealer, real estate, whatever. But for our purposes, it's a broker dealer. You're going to file for currency transactions of 10,000 or more, a CTR with FinCEN, because what we're concerned with is AML, anti-money laundering. We're trying to prevent money laundering. And the three stages of money laundering are placement, layering, and integration. That's, trying to prevent people from placing their dirty money. Then what you do is you mix your dirty money with your clean money. That's called layering. And then integration means you can no longer tell my clean money from my dirty money. Another document you're held accountable for besides the CTR is the suspicious activity report, and that's for 5,000 or more. And that's for transactions that are commercially, well, let's see, let's put that. Let's get a text box for that. Transactions that are commercially illogical. So if it doesn't make sense what you're doing, we're going to sign that, file that in SAR. By the way, it's against the law for me to tell you I filed it on you, so I'm not supposed to say, ooh, your life is about to get very exciting. No, right? One other thing before we move on and talk about NASAA, I would also be aware of, in this idea of money laundering, structuring. And structuring is where, I try and avoid triggering the CTR. For example, I bought a motorcycle. I tell the story, one of the lectures, it was $21,000. I ended up paying cash, not because I wanted to, because the dealer wouldn't let me have the bike with a check. I doubt my cashier's check is cash. But long story short, structuring would be, had I known he was going to file a CTR on me, I show up with 3 cashier's checks for 7, right? And the idea there is that I'm trying to avoid triggering the CTR, which would be a red flag. Now, I said when we started this discussion that the SEC is God and state administrators think they are. And so, as a retail investor, I'm coming to you from Nevada, as a retail investor, very important phraseology, retail investor, because, if you're an institutional investor, you should be capable of protecting your own assets, your own interests. But as a retail investor, on the federal level, the SEC protects me. And in my state administrator protects me, the state regulator. I think of the SEC as God and state administrators think they are. But all those things together, all those things are called blue sky laws. And so we may have to make sure that we're okay with the state administrator in terms of the securities we're selling. Looks like I lost my thing again. Let me get my annotation tool. I'll tell you, since we're talking blue sky, we'll put it in blue. Here. Blue sky laws. And I'd warn you that you're going to be taking another exam. A lot of you are going to be taking a Series 7 or Series 6, and then you're going to take a 63, 65, 66, and you're going to have to know how you register securities with the state administrator. For SIE, pretty simple, just to know that the state regulators, the state administrator, let's put that in here. This says it's the state regulator, but the proper term for that is the state administrator. That's the person who protects. That's typically the attorney in the state, right? The Federal Reserve Board is also got some power. The Federal Reserve Board tells banks how much they have to have in the till to meet their everyday demand for banking. The Fed also is in charge of what we call Reg T. Reg T is borrowing. Customers like to borrow money from broker dealers. By the way, that's part of 34. Prior to 1934, we as broker dealers were in charge of credit extension to our customers. And when we were in charge of credit extension, it was 10%. You give me 10 grand, I'd loan you 90 grand to purchase securities. That was called the Roaring 20s. And at the end of the Roaring 20s, everybody lost their money. And we said, well, maybe broker dealers aren't the best decision makers. We took it away from broker dealers, brokerage firms, and gave it to the Federal Reserve Board. So they're in charge of that. They're also in charge of regulating banks. The Security Investor Protection Corporation, broker dealers have fiscal responsibility rules. Broker dealers have fiscal responsibility rules. Let me clean this up. And if we don't, maintain our fiscal responsibility rules, SIPC is going to liquidate the firm. And SIPC is going to cover us for $500,000. $500,000. Let's see again. I'm trying to get my red one going here. There we go. $500,000, of which no more than $250,000 can be cash. And that's per separate customer. FDIC protects you in terms of a bank, and that's for $250,000. All right, so we're working our way through section 1, 12 questions on your SIE exam, and we're trying to make sure we get as many of these as we're entitled to. And let's just clean up our slide, and let's get rid of that. And let's move on up here. We said earlier, let me get my annotation tool here. We had said earlier that 33 says you're going to sell brand new securities to the public. You have to make a registration statement. Now, there are certain exemptions available under 33. There are certain exemptions available, meaning certain safe harbors where if I do it the proper way, I'm not going to have to make a registration statement. And one of the most popular exemptions available is what's called a private placement. A private placement. Key point, private placement. This is by invitation only, and this is an exemption under 30 called Reg D. And so Reg D says in 33, part of 33, that if I do a private placement and I don't invite retail customers, but all I invite is accredited investors and institutional investors, then I don't need to make a registration statement. Now, it would be important to know, as somebody who's an accredited investor, if you accept this, you're going to be buying unregistered securities that have never been through that process, right? So, again, registered securities means they've gone through that process of 33. Unregistered securities means they have not. And I can't imagine any draw of the SIE. I'm hoping for you a dream draw. Everything you studied shows up, on a phase of death draw. So when I say something's a guaranteed test question, I just mean I don't imagine a draw that you're not going to be tested on, that an accredited investor is $1 million net worth, exclusive of their primary residence. And so if I want to invite you into a private placement, I say, do you have $1 million net worth exclusive of your primary residence? And you say, well, Dean, I do not. And I say, well, then I can't send you a private placement memorandum. I say, oh, hold on, there's another one. Do you make $200,000 for the last 2 years and the expectation of that this year? Because then I can invite you as well. The assumption here, if you're making $200,000, you make a bad investment. So what? Work another year. Nobody really cares about you. In terms of protection is what I'm talking about. Expectation of 200K this year. You say no. I say, well, hold on, I got another one. Are you married and filing jointly? In which case it would be 300K for last 2 years. And the expectation of that this year. And that again is for married and filing jointly. Retail investors shouldn't be in a private placement. Now, there's two versions of, there's Reg D. It's beyond your SIE. I can't imagine you're going to see it on your SIE, but when you move on to your 7s, you're probably going to move on to a 6 or a 7. If you move on to a 7, we'll find out there's two versions of the Reg D, one where you can have 35 sophisticated unaccredited investors. PS for your own edification, not testable, for your own edification. People who pass their 7 or 65 are considered accredited if they're affiliated a firm. It's not testable, but that's one of the recent changes they've made to these things. So we've talked about accredited investors. Institutional investors are capable of protecting their own interest. And institutional is an unnatural person. So boy, it's like learning a foreign language. The accredited investors we just talked about are natural persons. It's in law. That means they're living, breathing human beings. Unnatural persons means not living, breathing human beings. When Mitt was running for office, Mitt Romney, he got a little trouble because he said corporations are people too. Corporations are unnatural persons, but he was trying to say that they have certain rights. So an institutional investor is an unnatural person. And within this category of institutional investors, not every institutional investor is a QIB, but every QIB is an institutional investor. A QIB is a qualified institutional buyer of securities. And again, I would know that. And as a qualified institutional investor, or buyer, they're allowed to buy unregistered foreign and domestic securities. And that would be somebody who has a qualified institutional buyer, somebody has assets under management of $100 million more dollars or more. And then, as I said, what they're allowed to do is buy unregistered foreign and domestic securities. Sometimes these qualified institutional buyers of securities. Let me get a different color here. Let me close up that. Let me get a different color. Sometimes what we'll do, we're talking about these institutional investors. We're on right here, 1.1.4 in the explication of our content outline for the SIE. And we're in the category called investors. I told you what a accredited investor is. I'm telling you now what an institutional investor is. And within that category, I'm telling you that there's a subcategory called a QIB. And a lot of times these QIBs will invest in what we call pipes, a pipe. And that stands for a private investment in a public company. So what they're buying actually are unregistered securities in a public company. So, for example, Tesla has said they're going to sell $5 billion worth of new stock this year. So they're going to sell $5 billion. Now, I don't know if that's going to be $5 billion registered or unregistered, but let's say it's unregistered stock. That means they could call T. Rowe Price. T. Rowe Price is a QIB, and say, hey, T. Rowe, would you like to buy $5 billion in unregistered Tesla stock? And that would be a pipe. They're making a private investment, meaning unregistered stock. That's what private means, in a public company. That's called a pipe. And the participants are what we call QIBs. And then retail investors is what it's all about on the SIE. The SIE is primarily about retail investors and the protection they have and the types of investments they make. So, the test doesn't assume you're going to be on the institutional side of the business. So, most of the test is around retail. And by the way, I don't know if it makes you feel good, misery loves company, but institutional men and women sometimes struggle, on the SIE. Now, there's various types of broker-dealers as well. Some broker-dealers do not like to have their own order department, their own purchase and sales department, their own margin department, or their own cashiering department. I mean, those are the departments of a broker-dealer to clear a trade. So if you're going to be clearing trades, you need an order department to transmit the order to the appropriate market center for execution. Then it goes to the purchase and sales department, which generates the confirmations. Then it goes to the margin department, who determines whether the monies or securities are due. And then the cashiering department collects the monies and securities. So if a broker-dealer has all those departments, it's a clearing firm because they can clear a trade. Introducing firms will introduce their customers to a clearing firm. Pershing is a popular clearing firm, National Financial. And so, my firm was Gamma Global. Gamma Global Investments is introduced to Pershing or National Financial. It's transparent to the customer that I'm not the one who's holding their money and securities, my clearing firm is. There's also what we call prime brokers. Those are clearing firms too. Goldman Sachs is big in this business. So is Morgan Stanley. I'm coming to you in the early part of May, And we just had a bunch of prime brokers lose billions of dollars because their customers blew up. But what a prime broker dealer does is provide custody and financing for hedge funds. You know, from a hedge fund, I don't want to get a whole bunch of different statements. I say, hey, listen, nobody has a monopoly on the ideas. And if I do the trade with you, your firm can charge me the markup, the markdown, or the commission. But my prime broker is Goldman Sachs. So I want you to settle up with them. That way I only get one set of, statements. So that's kind of helpful. If you're an investment advisor, you meet what we call the ABC test. The ABC test. You give investment advice. That's the A. You tell people you're in the business of giving investment advice and you want compensation. If that's what you're doing, that's called an investment advisory firm. And we have what's called the A. Whoop, I put it on the wrong one. Let me clean that up. That should have done. But we're not talking about individuals here. We're talking about firms. So like Fisher Investments, a big investment advisory firm. Do you give investment advice? Let's see if I can get my red going again. Do you give investment advice? You tell people you're in the business of giving investment advice and you want compensation. Well, then that is what we call an investment advisory firm. And, some of you are going to go take a 66 or 65 and, you're going to learn a lot more about that. So I tell people I give investment advice, A, B, C. I give them investment advice. My firm is in the business of giving investment advice and I want compensation for that. At most broker dealers, we have corporate finance, men and women who raise money for corporations, and we have public finance, men and women who help municipal issuers of securities. So some firms have a municipal advisory business where they advise the 50,000 plus municipal issuers of securities. 50 of those are states, so 49,950 cities, counties, school districts with $4 trillion in debt outstanding. And, we talked about the MSRB earlier, and the MSRB says if you act as a municipal advisor and charge the issuer to give them advice about what they should do. So example, I work as a municipal advisor at Goldman Sachs, and I say, here's what I think you should do. You should put this out to competitive bid so you can provide you with the best deal, and that's who you should award the underwriting to. And they say, hey, Dean, can you also underwrite the bonds? And the MSRB says, no, you can't switch your roles. Can't switch roles. Let me get a different color here again. From being a advisor to an underwriter. So you can't switch roles. They think that's too much of a conflict of interest for you to represent the issuer, represent the broker dealer, and in any of them represent your clients. And then we have issuers. That would be, you have three issues you're held accountable for on the SIE. So let's put that in there. The three issues you're held accountable for on the SIE are corporations, municipalities, and the U.S. government. It looks like I mangled it. And the US Treasury. And then you're held accountable for the various, ways those trade. So you either get those in the primary market directly from the issuer, or you can buy those in the secondary market. You can buy them used. Again, I'm not lecturing. I have an hour and a half lecture on primary and secondary markets. I highly recommend it. Right now, I'm just explicating the content outline and, kind of talking a little bit about these things that you're held accountable for. Now, all debt-denominated securities, whoop, let's go back here. All debt-denominated securities trade over the counter. So all bonds me get a different color. All bonds trade over the counter. And what that means is a negotiated quote-driven market. So what you're going to have is what's called a bond desk. And the bond desk will give you a quote on that bond, the price at which they're willing to buy it into their inventory or sell it out of their inventory. And, those are also some stocks. We have some stocks, not all stocks, but all bonds trade over the counter and some stocks. The stocks that trade over the counter are NASDAQ stocks, OTC bulletin board stocks, and pink. Yeah, I don't think that's a big deal, but, we, also have exchanges. But the traders are the people who work the desk and do that. So they're trading the security. And then market makers have inventory. They buy at the bid, they sell at the ask, we have some good lectures on that. But they're trading against their customers. They're trading against the customer, right? So I buy at my low price, I sell at my high price. These are participants you're held accountable for in your SIE. We have custodians and we have trustees who handle money. We have the transfer agent. The transfer agent is the person who affects change in ownership. Let me get my text box out here. So we got to have somebody who cancels the old certificate and issues the new certificate. And that would be the transfer agent. Now, these depositories, the Depository Trust Corporation, the one that shows up on the test is the Options Clearing Corporation. The Options Clearing Corporation is the issuer and guarantor of all options. So, you don't have to worry about whether somebody's going to perform on the contract. And again, these are not really lectures. It's just an explication of the things you're held accountable for. So I'll leave it for you to go, take this explication, take notes. By the way, you should have this content outline next to you as you're watching this. I mean, it's not too late. Stop, reset, whatever you want to do, and be taking notes. And then, what I use this is kind of an intellectual inventory as you go through your various lectures. If you're using the YouTube channel where you're finding this lecture, or whether you're using whoever your provider is, Kaplan or STC or Past Perfect. And, what you're looking for is confirmation. Say, oh, yeah, I remember when Dean explicated that. He told me that was something I should be aware of. Or if you're watching it on the YouTube channel, my YouTube channel, same deal. So that's kind of what we're doing here. So, if you're not quite clear, like I say, let me know, because that's the idea. And I'm going to do this for each of the sections. Let me clear up my slides. And I'm going to do it for all the exams as well. So this is our first explication of section 1, 12 questions found on the SIE. Now, I told you about the primary market already, but let's go ahead and get that fired up. Primary market is where the issuer receives the proceeds. Let me get that closer to where it belongs in terms of, there we go. And again, I got, a whole lecture on this. I'm not lecturing on, the analogy I give you, the art market. That's not the idea here. It's just, do you understand the difference? By the way, yeah, I would think of this anytime you're studying, there's 4 everything as you see here. I'd be prepared for like an A, B, C, D, A, primary market, B, secondary market, C, third market, D, fourth market. Depending on the question will depend on, what the proper answer is. In the secondary market, the previous owner receives the proceeds. So again here, what I'm suggesting is if they say, which of the following, A, B, C, D, does the issuer receive the proceeds? You'd say A, primary market. If they say, which of the following does the previous owner receive the proceeds? You would say the secondary market. The third market is listed securities traded over the counter. If I'm not a member of the New York Stock Exchange, I never agreed that I was going to trade securities between 9:30 and 4 o'clock on the floor of the New York Stock Exchange. I can trade those securities wherever I'd like. Twitter is a New York Stock Exchange listed security. Last figure I saw, 26% of the trades in Twitter aren't taking place in New York. They're taking place in the third market. But again, this would just be aim and shoot, point and click as an answer on your test. The three styles of questions are recognition, practical application, and judgment. On the SIE, you get very few judgment questions. Most of the questions are recognition and practical application. So as I mentioned, this is just flashcard material in terms of an answer. Now, if I'm an institutional investor and you're an institutional investor, we say, should we call Dean our broker and put him in the middle so he can charge us a commission? No. The fourth market can best be characterized as direct trading between institutions. So, I think of that as an answer set on your test. And depending on what they ask you will depend on what the appropriate response would be. If they say, which of the following markets can best be characterized as direct trading between institutions, you would say the fourth market. I have a beautiful economics lecture. So again, we have all the lectures here. So we're just adding. So let me know in the comment box or send me an email if you find the explication helpful or not. I'm coming up on about 45 minutes thus far. And I said, this 45 minutes is about 8 hours worth of lectures. So there's a part of me that, is wanting to go into more depth. And I'm just trying to give you an overview of the test issues. So what we're trying to do here is an intellectual inventory. I told you should have this printed out and have it next to you at all times. So, what you want to do is, can you intellectually put a check mark that, yeah, I intellectually own this? Because if you do, then, you're in pretty good shape, right? If there's anything in this outline through lectures or your study materials or through, Dean's lectures you don't get, you need to reach out and, put it on your Dean to-do list or somebody, or put it under control. All right. So you are testable. There's no draw. This is on this, again, part of your 12 questions in section 1. And, we don't know which 12 of this section you're going to get, but I would expect 3, 4, 5 questions on economics. They've dropped, if you're joining me for the series 7, or you're going to do 7 top off or 6, even though that's in the test specification, it seems like they're doing most of that testing on the SIE. So a big issue. So monetary policy test question is controlled by the Fed. Let me get my annotation. That's the money supply. And, too much money is a bad thing because, too much money chasing too few goods is bad. That's called inflation. And that's bad. And, too much money, too many goods, and not enough money, that's bad too. This one is called, let's just put them on here. This is inflation. That's bad. And this is called deflation. And that's bad. And so we don't want to have too much money in the economy. We want to have too little money in the economy. We want to have just the right amount of money in the economy. And the person who's in charge, or the organization that's in charge of monetary policy, the money supply test question, is the Federal Reserve Board. They're in charge of monetary policy. So it's very important, very testable to know that monetary policy is controlled by the Fed. And they have certain tools they use. And fiscal policy is controlled by Congress. Well, let's first put what it is. Fiscal policy is not the money supply, right? Fiscal policy is test question, government spending and taxation. And the second follow-up question would be, well, who's in charge of that? And that would be Congress and the president. I'm coming to you May of 2021. And right now, is fiscal policy in the news. Janet Yellen is the Secretary of Treasury. She has a big role now in fiscal policy, but she used to be chairman of the Fed. So, she has a good understanding of monetary policy as well. Listen, she's a smart lady. I've had the honor of meeting her a few times, and she used to, I spent most of my career in San Francisco, and she was in charge of that branch of the Federal Reserve for many years. Anyways, long story short, monetary policy, money supply, price stability, price equilibrium, That's controlled by the Fed, very testable. Fiscal policy, government spending and taxation is controlled by Congress and the president. And then there's certain interest rates you're held accountable for. And again, I would think of this as A, B, C, D again. A, B, C, D, right? A, discount rate, B, Fed funds. You need to know where the money's coming from and where it's going to. And so the discount rate is from Fed to banks. It's set directly by the Fed to member banks. And then the Fed tells banks how much they have to keep in there to meet the everyday demand for deposits. And that's called the Fed funds rate. And that is not set by the Fed. That one's, the most volatile, changes the most often. And that's from banks to banks. That's banks with deficient reserves borrowing from banks with excess reserves. Again, I'm not lecturing on this. I've got a great lecture on economics. It's one of my best. I highly recommend it to you. I'm just telling you the kind of things you're held accountable by explicating the Section 112 questions on the SIE. Business economic factors. Balance sheet, very basic. Assets minus liabilities equals net worth. I would definitely know that. The income statement. We're going to get these. We get these 4 times a year. We get 3 what are called 10Qs, quarterly reports, as public companies. And then we get 1 10K, and that is the annual report, right? And no, sorry about that. The annual report is audited, and the 3 10Qs could be our chief financial officer. We're also going to get an income statement that tells us our top line revenue, what our bottom line is, and hopefully we have a bottom line, we have a profit, net income. And then the board will decide whether to retain those earnings into the corporation or to distribute some of that as a dividend or to, authorize a stock repurchase program, whatever the board would like to decide to do. Now, you do get tested on the business cycle. There's the business cycle: contraction, trough, expansion, peak. And what you get tested on is knowing that 2 calendar quarters of declining GDP is a recession. I get a lot of people telling me 2 calendar quarters is a recession. Definitely would know that. And 6 calendar quarters is a recession, a depression. A lot of economists were asked how bad was the pandemic going to be in terms of the business cycle, and is it going to be as bad as the Depression 1920? And they said, well, we certainly hope not. We don't think we're going to have 6 calendar quarters of declining GDP. We did have 2, so we did have a pandemic-related recession. We have leading economic indicators that you're held accountable for, knowing that stock prices are a leading economic indicator. Lagging indicators tell us where we're at in the business cycle. Coincident indicators tell us where we're at. Inflation is testable. And, basic effects on the bond and equity market. So, in a recession, you wouldn't want to be in stocks, you'd want to be in bonds, or vice versa. Again, I'm just telling you what you need to prepare for as an intellectual inventory. I'm not going to go into a lecture now about bonds and equity markets. I'm just trying to explicate, the content outline. Cyclical stocks, the idea here would be to buy at the bottom of the business cycle and sell at the top. One that shows up a lot is defensive. Let me get out my annotation tool. Let me get myself a different color. I would definitely know defensive stocks. That's very testable. Are resilient to the business cycle. They deliver products and services resilient to the business cycle. I would definitely know the growth stocks. We don't expect them to pay us a dividend. We expect a growth stock to take whatever resources they have and reinvest in the business, right? So all of that stuff is pretty testable. We're working our way through the explication. The explication of Section 112 questions. And, did it look like I made it? Oh, just about. Wow. So one economist, what I mean by making it, I'm looking at my clock. I'm telling you, I'm trying not to, get this big thing passed. It doesn't look like I'm going to make it. I think I'm going to make it maybe an hour. Oh, well. Lord John Maynard Keynes, Keynys, Keynes, said that government spending and taxation can be a positive influence in the business cycle. Mr. Keynes said when the economy is weak, it's because there's no demand. And that what the government should do in terms of fiscal policy is step on the accelerator called government spending to, get the economy rolling, and then step on the brake, called taxation. So Mr. Keynes is, I don't know if he's smiling down on the proposals using fiscal policy. People who are against this are saying we don't need any more government spending to accelerate the economy. Things are going good. But, there's always the thesis and the antithesis. But, if you could test on the economic theories, it'd be, which of the following theories suggest that government spending and taxation can be a positive influence on the business cycle? That'd be Mr. Keynes, right? Keynesian theory. Theory isn't true, it's just a way of explaining things. The more theory can explain, the better that theory is. Monetarist is the money supply, and they put more emphasis on using the Fed and controlling the money supply to affect the business cycle. Now, by the way, they're not mutually exclusive. I mean, right now, the Fed is, purchasing $120 billion worth of securities bonds every month, right? They're using monetary policy to support the business cycle. Remember, they have a dual mandate. So Powell, who's our chairman now, says the dual mandate is both, price stability, but also full employment. And that's what he says he's working on now. International economic balance of payment. You are going to get tested on trade and debit and credits to the balance of trade, and how that's affected. So for example, right now the American dollar is very, very strong as compared to the peso. It used to be 10 pesos to get a buck, and now it's 20 pesos to get a buck. So what does that mean in terms of balance of payments? It means it's really cheap. That will help Mexico's imports to the U.S. My tequila is half price. What used to be a $40 bottle of tequila is now a $20 bottle of tequila. So when the dollar is strong, compare, by the way, that it's meaningless unless I give you the other currency. That would, cause our imports to go up and our exports to be less competitive. Our exports to our friends in Mexico cost twice as much. You do get tested on gross domestic product. That's the total goods and services an economy produces. And then I would know the spot rate. If I ask what's the spot rate on the peso, that means what is it trading at right now? They do ask that on the SIE. Let me just get my spot rate. Make sure you know that's the current exchange rate. I definitely know that. And again, watch the economics lecture. It's about an hour and it goes over all that stuff. All right. The last section in section 1 of the FINRA SIE content exam outline, for the SIE exam content outline, is about the various types of offerings. And we talked a little bit already about investment bankers who advise corporations. And as a banker, I might form a syndicate. I might ask my friends for help. Say, listen, I need some help selling this. Would you like to join my syndicate? We'll have a syndicate desk, and there's going to be members of the syndicate, and we're not all equal. One member of the syndicate is going to be the manager, and that's the one who's going to manage the deal. I've got the lead, so to speak. I'll have the syndicate desk where we keep track of the orders and the types of stuff we talked about, right? We talked about both public deals, 33, and we talked about a private securities offering. We talked about a Reg D, for example. We talked about a PIPE, for example. The traditional IPO, we would do our registration statement, and then we enter into what's called a cooling off period or quiet time. Now, most of us, when we make our registration statement, are going to say, hey, we might want to come back and get some more money and do a follow-on offering. So almost everybody, all issuers are going to do what we call a shelf registration. It's better to have the securities on the shelf at the SEC and not need them than need them and not have them. And so most all of us are going to do a shelf, and that shelf is going to be good for 2 years or 3 years, depending on what kind of issuer we are. Whether we're a well-known seasoned issuer of securities, in which case it'll be 3 years. And that means we don't have to make another registration statement. We can just take down, we'll say, I'm taking down my shelf. I'm going to use the securities I have on the shelf to do the deal. For example, Disney bought Fox. The way Disney paid for Fox was by using their shelf registration, securities that were registered but had not been issued, and they issued them to the Fox shareholders. Now, as an investment banking firm, if you want me to underwrite your securities, I can give you my best efforts, where I say, I'm going to do my damnedest to sell these securities, but my firm is not going to be liable for unsold securities. Or I can say, I'm so comfortable I can sell these securities. I'm willing to give you a firm commitment. As far as you're concerned, issuer, those securities are sold. Wow. So best efforts. I'm going to do my damnedest to sell the securities, but there's no liability to my firm. Firm commitment, I'm acting in my dealer principal capacity, and there is some liability to the firm there. As a consumer, you should be more concerned about a firm commitment. Best efforts, I say, what do I care if you don't buy the securities? I'm just giving them back to the issuer. Firm commitment, I actually own the securities. People forget that the Facebook IPO was a wobbly deal, but the Facebook IPO at 38 was a firm commitment underwriting with Morgan Stanley. Morgan Stanley told Facebook, the issuer, that they were going to get $38 a share firm commitment. So as far as Facebook is concerned, that stock is sold. Now, Morgan Stanley wasn't able to sell all that stock, and they lost $200 million. When they went to Zuckerberg and said, hey, it looks like we're not going to be able to sell the stock at 38, Zuckerberg said, sounds like a personal problem. See ya, wouldn't want to be ya. The way I understand a firm commitment underwriting, this is your stock in Facebook at 38. What you do with it is your problem. By the way, I think his understanding is correct, right? So official statements are the document we use when selling brand new municipal bonds. We almost always have a disclosure document. So, in Reg D, it would be a private placement memorandum. In a public deal, it's going to be a prospectus. And remember, not only do we have to make sure we're okay with the SEC, we also have to make sure we're okay with that state administrator. We have to make sure we blue skied it through coordination or notification or qualification. Okay, well, I think I made it through in about almost a little under an hour in explicating Section 1 of the SIE examination content outline provided by FINRA. Listen, ladies and gentlemen, no substitute for your other study materials, no substitute for the other lectures that you find in the playlist that spend literally hours on things I spent 5 minutes on. But I did want to give you an overview. Let me know if you find this helpful. Hit the like button. If you didn't find out, hit the unlike button, because I need to know, because I'm not gonna do Section 2. People say, hey, Section 1 didn't speak to me. I'll skip it. So I'll also be doing this for the other exams as well. So you can guess what will be next is Section 2 on the SIE. And I'll probably get Section 1 of this 7 done here pretty soon. All right. Study hard, and, stay dedicated, stay disciplined, stay organized, and you can certainly make your mark.